Hi guys, this is Matt Z from Optimus Futures, and very, very privileged to have Jack Schwager here with us. First of all, he's a legend in the industry. You guys know that. But I don't know anybody else in this industry who has actually given traders more practical advice. There's a lot of educators out there, and there's a lot of academics out there, and there's a lot of technicians and fundamentalists and all kinds of stuff. And when I listen to Jack, he says it like it is, because whatever he says, I see it with real traders. So I brought him here today, and he asked me specifically not to give him the questions ahead of time, which was a really, really nice surprise. And what I think about that is because all the answers will be authentic, they won't be prepared. He will say just like it is. And Jack, I want to show you something. About 20 years ago, over 20 years ago, when I started in the industry, my friends gave me your book. My friend, okay? And it's Schwager on Futures Technical Analysis. One of the best books I've read. I still have it today. They dedicated this book to me, as you see here, but it's missing your signature. So hopefully when you'll be here in Boca, you'll come and sign it. So let's start with the questions, okay? And I'm going to ask Jack questions that I hope will help you become better traders. I'm not here to describe trading as an easy concept. I've listened to a lot of Jack's webinars and seminars, and I've gathered some questions here that I think would help you out. So my first question is this. From the time you have written your first book of Market Wizards, are today's traders need a different set of tools or characteristics in order to succeed in the marketplace?
Well, different approaches may be in some cases because the structure of markets has changed. I don't know, for example, if crypto is going to be a legitimate market long-term or not, but obviously there were no crypto markets back then, or even a few years ago of consequence. Also, I just think in terms of, well, I mentioned to you that I was working on a new Market Wizard book, and I've interviewed a few people so far. In one of my interviews, the trader uses a technique that just couldn't exist before because he uses data from social media to gauge when there's an inordinate amount of talk about something, and that's actually the key component of what he's doing. So, in terms of technique, that's an approach that didn't exist before. In fact, I was thinking, I said I'm going to title that chapter "Neither," because people are so used to saying, "Oh, you're a fundamentalist or a technical analyst." Well, here's somebody who's neither. He's not using fundamental analysis. He just now is using social media indications, which just didn't, it's a completely different way of doing things. So because market structures have changed, some things have changed, but underlying principles are still the same. Certain elements of trading are tied to human emotion and go counter to human nature to be successful, and those elements are the same through time. So there are certainly big common denominators, regardless of whether you're talking now or when I wrote the first Market Wizards book, which I guess is like 30 years ago, or if you go back to a book like Reminiscences of a Stock Operator, which I was reading 65 years later before I wrote my first book, and that was still pertinent then to me, just like I hope my Market Wizard books will still be pertinent 65 years later, and they're at least seemingly pertinent still 30 years later by virtue of still selling. So the answer is both. It's the markets have changed, and that changes some of the techniques. Some things that worked before may not work now, but the basic elements of what makes a trader successful, that remains the same through time.
Such as risk management, watching your equity, understood. My next question is this. what does a successful trader worry about as opposed to a beginner trader? So you'll have somebody who's successful in trading, and you have somebody who's starting out and not doing that well. From your experience, I've noticed you in one of your lectures, you said something about what they worry about are totally two different things. So can you elaborate on that, please?
Sure. Successful traders worry about or focus on not losing money. Beginning traders or traders who really haven't learned the art yet worry about how they're going to make a fortune. So it's a completely different emphasis.
And you find that it's more emphasis on risk management as opposed to methodology?
Yeah, absolutely. So if you interviewed 100 successful traders, virtually all of them would tell you that making sure they preserve their capital or risk management is by far more important than how they get into the trade. Again, I'm thinking of another interview I just did for the book I'm working on. So that trader is basically using chart analysis as an approach and traded for decades, many decades using chart analysis, and very, very successfully. But when questioned about how effective are charts, how much of an edge is there, he's the first one to admit very, very little edge remains. I mean, to some extent, charts have become too popular. You have to adapt from it in many ways. But the edge comes not, according to him, not according to me. His edge comes not from the fact that he's using charts. That's just a way to signal a trade. But the edge comes from his risk management. And I would agree that having discussed his approach in detail, that's probably true. So the message is that beginning traders think it's all about finding the way how to get into a trade, where actually that's not right. It's really all about how to get out of a trade. Getting out of a trade means two things. It means, first and foremost, getting out of a trade without that trade damaging your ability to continue trading, or in other words, damaging your trading stake, so to speak. And it also is a matter of having some idea, okay, well, if the trade works, where do you get out? So, but there's more emphasis on getting out than getting in, I would say, among professional traders, about the importance of getting out as opposed to finding a great way to get into a trade.
Thank you. Okay, my next question is about the return belief system that beginner traders have, whether they're day traders or swing traders. Can you talk a little bit about the consistency in trading in terms of returns for long-term traders? I think a lot of the retail traders, for example, think if they'll put X amount of dollars, they can get X amount of dollars consistently per month. Do you find that amongst good traders, there is consistency, or they're just all over the place? And in the end, you just average their returns to something which is positive. How even the best traders out there, what are the real fluctuations, in their equity?
Well, there are some traders who had amazing consistency, but they are the exception. So I think of somebody like Ed Thorpe, who was actually famous to the world, not as a trader, but because he wrote this famous book on how to beat the house in blackjack, and he was a math professor basically. And but as a hedge fund manager, he had an unbelievable. He actually had two different hedge funds. He had one and then restarted another one years later. But like taking his first hedge fund, which lasted 19 years, 19 years, he had 3 losing months in 19 years, and in all 3 months were less than a 1% loss. So, and I figured out the probability of that. Of his track record, that many wins versus just such tiny losses. And under conservative assumptions, his probability of getting that record was less than the probability of selecting one atom out of anywhere in the mass of the Earth, not the surface, but the entire mass of the Earth, and then randomly selecting another atom and getting the same atom. So that probability is so far, so I have to explain it by analogy because the number is so large, people can't comprehend. So a track record like that is so super consistent, it's just mind-boggling. But he did it because he found ways that there were inefficiencies in the market and he was able to exploit them. But that's unusual to get that type of consistency. If you take a more ordinary, not more ordinary, but a more standard approach to trading, no, traders, like I mentioned, one of the fellows I interviewed for this new book, he's been trading like 40 years, but he still has a few, he still has 2 or 3 or 4 losing years in there. Now, yeah, I mean, so if he made 36 years of profits and 4 years of losses, that ends up to being a pretty darn good record. But for the most part, even really good traders, will have periods where they lose money. And the idea, in fact, one of the lessons I try to give is don't think in terms of objective. Don't say that I'm going to make 30% a year this year or whatever number it is, because that's not realistic. The market is not a machine that spits out a constant number of opportunities, regardless of what your approach is. There'll be, no matter how you approach the market, technical, fundamental, or whatever way, that methodology, there's going to be times where it's working well and there's times where it's not. There's going to be times where there's opportunities, there's going to be times when there's not. So it's unrealistic to expect this kind of constant opportunity. And if you do, and you have some goal that you feel you have to reach, then what's going to end up happening is you're going to put on trades where there's really no opportunity. You're going to risk money where you shouldn't be risking money, and it'll only be detrimental. So no, there'll be times where it'll be great years if you're a good trader, of course, and there'll be times where even if you're a really good trader and doing everything right, you'll still lose money. Even the best traders, with rare exception, will go through periods where they lose money just because it's a probability game. No matter, even if you have a very good approach, you're going to lose a certain percent at a time. And if you do things, like if you toss 10 coins in the air, it's not going to usually end. It's going to be rare for it to, not rare, but it's be uncommon for it to turn up all 10 heads. But 1 out of 1,024 times, it will be all heads. And if you're trading thousands of trades, that means, if you were equal chance of winning or losing. And for many traders, they are less than equal because they make more than they gain. But if you say equal chance of winning or losing, then you should expect you'll have 10 losses in a row. So you need to understand that even just random probability will result in good traders having streaks where they lose money.
Thank you. I also noticed that you mentioned that when you examine good traders, focusing on returns alone is probably very misleading. I want you to elaborate on that. I understand the concept because I understand of somebody who achieves 10% being a day trader versus achieving 10% in selling premiums. But elaborate more with professional traders that you met and the risk that they take. What is beyond returns?
Okay, well, first of all, because I've been in a position in different roles in my life where I have to evaluate traders, and I tell traders that the least important statistic is return, because we have traders say, "Oh, I made 50% last year," and here's my rate. And I say that not facetious. I'm not being facetious when I say returns are the least important statistic, because by itself, returns are a meaningless number. So I can prove that very easily. So everybody listening to this broadcast, listen carefully, because I'm going to tell you how to double. If you're a profitable trader, I'm going to tell you how to double the money you're making. Proof, absolutely, definitely, this will work if you do everything the same. If you want to double your profits, all you have to do is double the size of your trades. Now, does that make you twice as good of a trader? No. All it means is you're taking twice as much risk. You'll have more chance of being knocked out of the game. So the amount of return by itself doesn't mean anything. It depends on what risk you're taking to get that return. And I only look at return risk statistics. So return is only a numerator in some statistic. By itself, it just really has no meaning. Because you can have people, in fact, I think I've used this analogy in one of my books. Imagine you have 2 traders, they together, they're technical in nature and they're computerized and they come up with this trading system. But one of the guys is very risk tolerant. He wants to trade 30% margin equity. And the other guy is very risk averse. He wants to trade 5% margin equity, and they can't agree. So they finally separate. They form two separate companies. They trade the exact same system, but one guy is trading 30% margin equity, one guy is trading 5% margin equity. So it's just a difference of how much leverage they're using. One is using versus the other. Now, one is going to make a lot more money for a lot more risk, and the other one's vice versa. But it doesn't mean that one's a better trade than the other. In fact, I've just given you an example where they're trading the exact same system. So it's a question of your individual risk tolerance. And the fact that you're making money by taking more risk doesn't make you a better trader. It just means that you're willing to take a lot more risk, and that has its own downsides.
Thank you. My next question is, how are successful traders adjust to different markets? Meaning that, I'm dealing with retails, and in retail, it's like fashion. They jump from one method to another. One month it's price action, the next one is Fibonacci, the third one is, market profile. They say this one, and that one. And I know this is not the right approach. The professional traders, how do they adjust to different market conditions in the marketplace when there's higher volatility, lower volatility? I know traders that you yourself consulted, like Tudor Jones. He traded in the 70s as a pit trader, and he trades today as well. How do they go through all those decades with success and maintaining a reasonable drawdown that doesn't kill their trading account?
Well, they do adapt to markets. Doesn't mean they change their methodology necessarily, only if the methodology stops working for whatever reason. But by adapting, you talked about volatility. So, for example, one of the traders I interviewed, a hedge fund manager, in a book called Hedge Fund Market Wizards, sort of talked about the 2008 period where volatility had tremendously increased. And his point was, when the markets become much more volatile, you just have to trade much smaller. So he recounted, like, he would run into hedge fund managers and they would say, oh yeah, these markets are really crazy. I've cut my trading size in half. And he would think, cut your trading size in half, the market volatility has increased fivefold. So even though they thought they were adapting, they really weren't sufficiently because they didn't fully adjust for the change of volatility. So that's an example, which you mentioned, that the trader has to adapt. If a market's much more volatile, it's not the same as trading the market when it's much less volatile. There are times where markets become much more correlated, risk on, risk off. So there, normally say something like commodities and stocks go in different, they don't have any correlation. In fact, if anything, commodities are more likely even sometimes to go up when the market's down. So if anything, over time there may be an inverse correlation. But we had periods in the last decade where you had risk on, risk off, and markets that was as unrelated or even inversely related as stocks and commodities will be going up together. Well, if you're in that type of market, then you have to be cognizant of that, because a lot of your positions may be going up and down the same, and that means there's a lot more risk in your portfolio than there wouldn't otherwise be. So you always have to be cognizant of the environment that you're trading in, and specifically the risk that is associated with that environment. And there's another element of it is markets don't always continue in a way that the same techniques will work over time. So, for example, trend following was extremely effective in the early days, when in my first Market Wizards book, and I was talking to traders who had started trading. In that case, where traders had started as early as the late 1960s and late 1960s or 70s. During those periods, you had trend following was working tremendously well because it was new. I mean, we were still dealing, pre-PCs. People weren't, computerizing systems. But you go from that world to where everybody and his brother can have, a trend following system, and the approach begins to lose. Now, it doesn't mean markets don't have trends anymore. Markets still trend, but they do so now typically in such a choppy, volatile fashion that there'll be so many whipsaw losses that it'll make sure that the markets, it'll make sure that people end up net losing, even if there is a trend. So it doesn't mean that market trends don't exist. It just means the simple methods of exploiting them don't work anymore. But by and large, I mean, I guess if they stop working, if they work badly enough for long enough, they'll start working again simply because people will abandon it. And if too many people are doing something, it's just not going to work. And I guess it's totally possible the technique will work better again in the future because so many people will be discouraged. Actually, analogously, it has nothing to do with trend following or technical analysis, but this comes from the world of somebody who's a pure fundamentalist. Joel Greenblatt of Gotham Capital, he's a value investor, and he completely, wouldn't look at a chart. But he had a saying which kind of makes the same point. He said, his three rules of value investing, and his three rules were: 1, value investing works; 2, value investing doesn't work all the time; and 3, rule 2 is why rule 1 works. So if it worked all the time, everybody would do it. But the fact that you can go through a period like 99, late 1988, 99, where the smartest people like Buffett and the smartest investors were losing money, and the dumbest investors were making money by buying these stocks that a year later would be worthless, but they were just getting on the train of internet stocks. So in a situation like that, value investing not only doesn't work, but it was horrible. But because you get periods like that, is why it works over time. So that's the way markets are. And it goes back to the point you talked about earlier: consistency. Well, the markets are like that. No approach will be consistent through time.
Thank you. I want to talk about the traders that started in the beginning and they had a lot of challenges, so they didn't succeed. And later on, they succeeded. First, I wanted to know what, in your opinion or from your observation, made them continue when they lost money. Because a lot of traders come in, they lose money, and then they move on to either other asset classes or they just move on from trading. But those who succeeded, what do you think why did they continue? I'm really looking specifically, I'm asking more about their nature and what they improved in their trading in order to get to where they are, to be consistent I shouldn't say failure because nobody was born a trader, but let's say from being challenged by the markets to being more successful. What have they done?
Well, there are actually, surprisingly, if you read all the Market Wizard interviews, a surprisingly large number failed in the beginning. It's the exceptions that were successful right from the beginning. There are some, but they really are the exception. And I think I can go back to the very first chapter of the first Market Wizard book, a fellow by the name of Michael Marcus, somebody who would be completely unknown to the world if it weren't for the book. I mean, I knew him personally. I even had worked for him. But in any case, Michael, and he started out and just blew out one account after another, even at one point where he thought he was starting to make it, made some money, then bet it all on one trade, and even borrowed from his mother. He came from a lower middle class background, so it wasn't like he had wealth in his family. On the contrary, and then he ended up losing all his own money again, and a portion of his mother's meager savings. When I asked him, as we were recounting all these failures one after the other, didn't you ever think of just giving up? And he kind of uses it not literally, but like the scene in Fiddler on the Roof, where Tevye is talking to God, and he doesn't he doesn't mean it literally, but he says he got to the point, he's like looking up and saying, God, am I really that hopeless? And he just heard, or just that no, you just you can do it. You just have to continue. So he had this inner belief that he could do it. Now, I'm sure some people may have that belief and they're wrong, but in his case, of course, it was right, and he became enormously successful. So with the lesson in that, I guess I draw two lessons from this whole thing. One is early failure doesn't necessarily mean that you're going to be a failure long term. I mean, there's lots of stark examples that I've come across where people failed and then were tremendously successful. And the second element is that the people who do succeed have this kind of inner drive. They're just something inside of them just drives them, and to the point where they're ultimately successful. And they kind of, and it doesn't have to be, of course, trading. I mean, I think this is true in almost many careers. I mean, people, they could start a business, where they feel they're going to start a business or an internet or whatever, a company, and they may fail a couple of times and then eventually are extremely successful. So I think everybody has certain skills and certain drives and certain passions of what they want to do. And so for the right people, that they just don't give up. They just don't give up on their objective and goal. And that's kind of a unifying theme of all these traders who initially failed. And of course, to become successful, they eventually learned what they were doing wrong, and they had to change what they were doing. But they had this just refusal to give up.
And those who are successful or successful traders outside of trading and outside the markets, do you find that they have a certain way that they think of things, or certain behavior traits that they have outside of trading and outside their office that is common to all of them? To the way they think, they view the world, or just I was just curious I was always curious. A friend of mine asked me once, can somebody paint fences who paints fences become a good trader? And I truly didn't know what to answer, because I don't know the process that it takes to become a good trader. I know people are good traders, and I see that all of them had good careers. They were successful even prior to trading. But, I just wanted to know what kind of habits a person can adopt in his day-to-day life that would help him in his trading. At the early rises, do they exercise a lot? Do they read? I mean, what do you notice about them that is common to them, which is more common success, common to success?
Right. These traits you're talking about, these personality, it's remarkable how there are no common denominator. In the Wizard books, I'm always trying to get to the message of what are the common denominators, but they're never anything to do with personality or trait. So some are conservative, some are liberal, some are really nice, quiet spoken people, some are you wouldn't want them as a neighbor, some are I don't know, very active physically, extremely active, almost athletic, and some don't want to get off the couch to get a bag of potato chips. I mean, so it really ranges all over the map. So I've never found any personality types or that are common to traders. And some could be brilliant, some could be brilliant academically, and some dropped out of college, and they obviously have some sort of smarts for trading or whatever, but not necessarily book smarts. So it really does vary tremendously, and I don't have any common denominators when it comes to that.
And I'm glad you answered that, because I'd like to think that if somebody puts enough effort to study about risk management and listen to people like yourself, have experience with good traders, would be able to adopt it. I want to give you a chance to talk a little bit about your projects and give you the stage a little bit about things that you do. I want to talk about Fundseeder. I want to find traders in Optimus that would be able to fit the Fundseeder model. Can you tell us a little bit about what you're looking for, how you put it together, what are the parameters that people need to fit, that you would even consider them, to raise capital? But let's talk about Fundseeder in general and its purpose.
Okay, so definition of Fundseeder, basically, I should say right up front, it wasn't my concept. It was my colleague, Emmanuel Bellari, who I think you know.
He's a great guy.
Yeah, and so Emmanuel and I first met each other. I was working for a London-based hedge fund advisory firm called Fortune Asset Management. Fortune got acquired by Close Brothers, which is a merchant bank in the UK. I was the only US employee. I was a partner. And I just, at that point, there was no point in my staying with the big company, which had very little to do with alternative investment. So we negotiated out. Everybody, on terms that we were both happy with. And actually, I took a sabbatical then to write. The British have this nice thing called garden. What is it, garden leave or something like that, where in this type of deal you kind of get paid for a period of time for doing absolutely nothing, so, and you just get a salary. That was part of our agreement. But anyway, I took that time to write Hedge Fund Market Wizards and another book, Market Sense.
I thought that's only in France for 2 months during the summer.
UK too. Said Market Sense Nonsense was the other book. But also after that, one of our clients was ADM, and Emmanuel had a subsidiary with ADM, and the idea was they wanted to form a commodity CTA type portfolio. And since that was my focus with Fortune, I tried to get them to do managed account structures. So in any case, we picked up from there. So that's where we know each other. So one time we were at a conference and we're having dinner, and Emmanuel throws this idea out about FundSeeder. And the basic concept is, to create a global, a net, on a web-based location where you could connect traders who really have no access to capital, and or undiscovered traders who might have skill but no way connecting with investors. And on the other hand, investors or companies that run investments that are looking for new emerging managers. So there'd be a connection between the two, kind of a global hub. And that was the basic concept. And I said, actually, that's a pretty good idea. And part of the concept was to have the trading records come from directly from brokers, as opposed to, because if you have traders submitting, you don't know what's right, what's wrong, what's true, what's not. And so that was the general concept. And the concept was then to connect investors and traders, although now, as we've evolved, really the focus now is a little different. It's not much different. It's still to find global trading talent. And by global, we have literally traders from more than 100 countries signed up. So literally to find globally traders who have skill, but not necessarily access to the way of earning money besides their own trading, but no way to multiply that in some way by also having asset management. And on the other hand, people who want to tap into that skill. So what we're doing now is to construct an index of those traders, and actually just one to begin with, but there'll be others. And so that's the basic concept. And we've been running for multiple years now, almost 4 years, a FundSeeder trader index, where we take the top traders, the top 5% of traders, measured by our proprietary return risk measure, not return. So we take the top traders, top 5% at the end of any month, and they become the traders that are assumed to be equally allocated to in the following month, and that forms the index track record. So the index has no hindsight, because the traders that are in the index on any given day were selected as a performance at the end of the prior month. And it changes every month, the portfolio changes. So that index has done quite well on a return risk basis. And so we're currently in the process of turning that into an investment product. And so bottom line, traders who are part of the index would get compensated for being in the index. And we would be tapping into trading talent that is not accessible anywhere else. So that's the long and short of it.
Great. I hope to integrate one day into that platform. I think it's one of the better platforms out there. I've seen its parameters that you use, and I think even for individuals who follow their own trading, I think you did a great job. Just to let you know, from my experience, some of my customers turned into CTAs, and I think the biggest challenge that I've seen for some of them is actually the psychology of trading other people's money. It really burdened them. I've seen it. I've seen amazing track records that have been there from 3 to 5 to 6 years. And the minute you give the money, I always tell them it's not just the trading. It's going to be the pressure of working with customers, and a customer picks up the phone and he says, we're down 5%. Do you think you're going to recover? All the brokers in the world, they call CTAs, what have you gone long? Obviously, you should have gone short. And tell them that plays a big role in their psychology. You're going to be a very strong character of really never to listen to anybody. You've said it 1,000 times, but I've seen it from real practical experience that as a trader, you can't listen to anyone. Not to brokers, not to your customers, just continue with what you're doing.
Yeah.
My last question was actually, it's something that you said. You said in one of your seminars, I think you did it in Denver, I'm not sure, that you said good trading is effortless, right? I really need you to expand on that, because you also mentioned that you've seen a lot of traders that you believe, I think you said that, you don't believe that a way to recover is work harder, right? When you're going through bad periods. Can you explain the concept of effortless versus, the market? Go ahead.
Yeah, in my talks on trading, I kind of, actually in the same talk, I will make the point that hard work is essential. Many people want to get in markets because they want an easy way to make a lot of money. And I point out that people who've really been successful are very hard workers. But right after that, shortly after that, I make the point that you just said, that good trading is effortless. And that sounds kind of paradoxical. I mean, like, I can't make up my mind. Is it hard work or is it effortless? And the answer is it's both. So the hard work is involved in kind of developing a methodology and doing all the research and keeping it up and being disciplined. And there's a lot of things that go into, the hard work part of it. Mostly, of course, is coming up with a methodology that works. That really takes a lot of effort. But when you're actually trading, and here this I mean to apply to people who are trading discretionary. If you have a trading system, then it's not an issue because the trading system's running and it's running. I mean, okay. And if the trading system is a valid system, is a good system, then if it's going through a drawdown, then you should let it alone because, that's part of if it's within its normal boundaries, that's part of the process. But for probably the majority of traders who trade not by an automated system, but are making decisions, then virtually every trader will run into the situation where even if they're doing everything they're supposed to be doing, they're going to just go through everything they do is wrong. I mean, by wrong, I mean not methodologically wrong, but wrong in terms of wrong with what the market is giving them. They may be doing the right thing, but the market is giving them a loss. And it's whatever they do sort of ends up ending the loss. And it's frustrating periods, and virtually all traders go through it. So my point is, when you get to a period where every decision you make seems to end up virtually, they just end up being wrong in terms of losing money now, not in terms of contradicting your methodology, then you can't just try harder. You can't do more trades to make it good. You have to just move away. When I ask traders when things are going bad during bad periods, what do you do? And the answer is typically, well, I stop trading. It could be for a few days, could be for a few weeks, but they just stop. Or they might just cut their, one trader said, well, he might trade 2,000 contracts, at some point, normally, but if it's going back, he'll cut back, he might cut back to 10 contracts, so you just drastically cut your position. So the losses relative to your equity size is not consequential. Now that doesn't work for a tiny trader, but if, people have any type of size of account, that could work. You just cut down the size. But more often than not, the answer is you just stop trading so you can kind of come back for a clean slate and try again. But trying harder doesn't work. And there's a quote from I used from one of the traders where he asked me, did you ever read a book called Zen and the Art of Archery? And I kind of say half jokingly, I'm afraid I missed that. And he said, no, I'm absolutely serious. And he quotes, and I use this quote, I quote him exactly here. He said, whenever there's any effort, force, struggling, straining, or trying, it's wrong. And everybody who's been a trader knows the truth of those words. So when it's not going well, you can't fight against it. You have to just, go end of that round, go away. You'll come back another time.
I know that trader. That's the trader that actually you couldn't publish, right? That's the trader that, yeah. Well, first of all, that's all the questions I have. To our viewers out there, I just wanted to let you know, we're going to list the Fundseeder website, the links below. We're going to link all of Jack's books, The Market Wizards, and all the books that he wrote below, so you can purchase them on Amazon. Jack is going to come up with a new website. When he does, we're going to publish it as well. When he comes up with new books, we're going to update this link, because what I think you do is just incredible. It's amazing the amount of time that you have dedicated over your life to just help traders and say it like it is. Because I got to tell you something, in our industry, this is not the case. So I'm happy there's people who are down to earth, who say it like it is, and hopefully they'll inspire the next generation of traders out there. Jack, again, thank you for your time.
Thank
And hopefully we'll see you again here at Optimus Studios.
Okay.
All the best. Thank you, Jack.